All right, what's going on, everybody? Welcome back to Forward Guidance. We got the man himself, Darius Dale, 42 macro. Needs no introduction, but we'll give it anyway. Darius, how are you, my dude?
I'm doing really good, man. Thanks for having me back on the show. You guys are doing great work, keeping everybody apprised of all the carnage going on out there. So let's just hop into it.
Yeah, when vol gets us high, things move fast, to say the least. Yeah, ton to get into. I know you got some charts, as you always do, which is I'm super excited to get into. But I want to, just start this conversation where, what is the key narrative in markets today? And I want to hear about how you were thinking about markets going into Liberation Day last week. And how did markets react versus your expectations of that? And how were you thinking about this process up and towards here we are today with risk assets rebounding? Is that just a bear market to be sold? How do you think about all this?
Yeah, a lot of good questions there. So I'll kind of go from in order here. So heading into last week, we've been of the view that two things were likely to occur in 2025 that were not priced in, as recently as, late February. One, there's likely to be a global debt refinancing air pocket in 2025 because the Fed and other key central bankers, namely People's Bank of China, were not proactively supplying liquidity in a way that would ease that process. And then number two, which is obviously more important to markets today, is the Trump administration appeared to be very serious about the process, the sort of fourth-turning inspired process of transitioning the U.S. and global economy from what we call paradigm A, which is this sort of bloated, K-shaped, top-heavy economy that's really been, perpetuated by or really supported by excess fiscal stimulus in the United States, to what we call paradigm B, which is this sort of egalitarian E-shaped economy where every rung of society is kind of moving and rowing the boat in the same direction, and that's perpetuated by kind of a rebound in private sector investment and ultimately hiring activity. That's a big forward turning style transition, just given the precondition of all-time high corporate profits, corporate profit margins, all-time high risk asset prices, some of the most aggressive valuations we've ever seen in risk asset prices. And so it was our view that if they were serious about the transition, which going back to our research from late January all the way through now, all the sort of tea leaves we were piecing together, it gave very clear indication to us and our clients that they were serious about this transition and that transition wasn't priced in. And so ultimately we were of the view that Liberation Day was going to be worse than expected. It was going to have significant market ramifications. And ultimately it's likely, to the extent the tariffs remain on, in which we do believe that's the high probability outcome, is very likely to have significant economic ramifications that aren't priced in.
Yeah, absolutely. So, now it feels like markets have to quarrel with, to your point, how much of this will be durable. We got the worst of the worst expectations become reality last week, and that led to a very quick and aggressive degrossing of a lot of risk assets. It's really interesting to me to see the cross correlations between asset classes, where in the lead up until basically Friday, it seemed like it was pretty calm selling, willing sellers. And then pretty quickly we started to see, gold down, equities down, rest of world equity, which was outperforming the US markets up until that point, basically, that started to blow over too. A lot of things started to roll over all over at once. And it really seemed like we got into this point of margin call starting to get hit. So yeah, how do you think about the durability of this? You're saying that markets are still underestimating how persistent these tariffs will be. It's not just going to be, obviously by I think midnight tonight is when we're supposed to see these tariffs go live. You're of the position that these are the real deal and they'll be sticking.
Yeah, we're of the position that the Trump administration is serious about this economic transition from paradigm A to paradigm B. If you can throw this chart on the screen there, where we show what I believe to be the most important chart of macro. This is a share. This chart shows labor share of national income, which is all the way down here at 51.5%. That's the blue line relative to capital share of national income, as noted by corporate profits, as a share of gross domestic income. That's all the way up at an all-time high of 14%. And you take a step back, just psychologically as a human being, President Trump has been to every podunk town in America, for lack of a better word. I don't know if that's pejorative or not. Correct me if I'm wrong, but he's been every podunk town in America, every town in America that's just abandoned factories. There's economic hardship. There's obviously opioid abuse. He's been to every single one of those towns in America 5, 10 times over the past, 8 plus 9 plus years. since he became a presidential candidate back in 2015, 10 years now. He's shaking hands with all the people that was left behind by globalization. And ultimately, he believes that he dodged an assassin bullet to fix it, right? Like he thinks he was, you listen to what he said at his State of the Union address, he thinks he was spared by God to correct this toxic imbalance. I've been calling out this toxic imbalance since I first created this chart back in the early aughts, back down here when it was on all time, record wide and getting worse. The spread narrowed the first time we saw in President Trump's term the first time, but then it got blown back out again as a function of the, triple the U.S. is quadrupling down on this sort of concept of globalization is great for all. Well, the reality is globalization is not great for all. It's only great for the people in the top part of the K. So I think what President Trump is realizing is that the only way for America to enter a golden age whereby the median American is winning and not just the mean American, because obviously the mean gets, the wealth and income gets concentrated at the top. In order for the median American to win, the people who've had all the income and wealth concentrated at the top need to lose the game. And so that ultimately means that this chart here needs to compress over a sustained period of time. And ultimately what that means is that Wall Street, which has been benefited from globalization as much as anybody, right? The Wall Street we're financial people. We're here to create profits. We're here to, find efficiencies and productivities and create profits. And globalization has been one of the most powerful forces in human history to do so. And ultimately, Wall Street's a loser in this paradigm shift. The rich people, the folks who own all the assets and the companies, I want to say the top decile, top quintile of Americans own 88% of all financial assets in the country. Those people have to lose the game in order for the median person to catch up. They're not going to catch up unless you start to inflict pain and impose costs on them. So it's our view that, the tariffs may come down. They may get negotiated down when other countries wave the white flag and say no mas. But the reality is we're not going to take them down. They're going to have to wave the white flag and say no mas and drop all of their tariff and non-tariff barriers to trade. And that process, in my opinion, is going to take some time. I think we need to see, probably a global recession before everyone capitulates. Certainly China's not going to capitulate. We saw what their rhetoric is this morning. It's actually moving in the wrong direction.
Mm-hmm. Absolutely. I think Treasury Secretary Scott Bessent put it best in a recent interview where he said, this is a Mag 7 problem, not a MAGA problem, effectively. And so, yeah, let's double click on this idea of the sequence of this compression between these two charts. And we'll get into the market impact of how investors can deal with that. But first off, I want to just hear about how do you see the sequence of that in terms of the economy itself? So if you're of the mind, and you can validate this or not, that through the past couple of years, we've had indeed a K-shaped economy where the lower income classes, would you agree that they've been in some sort of a soft recession that's hiding underneath the top line data? Whereas the top income earners, they've been doing pretty well where their cash is receiving 4.5%. They've seen risk assets hit all-time highs on a daily basis. There's been a lot of fuel from fiscal deficits. And so, yeah, first off, digging deep into that economic sequence, how do you see that transpiring?
Yeah, no, I'll start by saying the precondition was unsustainable. You and I have talked about the U.S. being in a fourth turning historically. I want to say about 50+% of all income was occurring to the top 10%. As most recently, I want to say it's the latest annual data we have is about 2023. I'm sure it got worse in 2024. By the way, we had a big raging bull market that we were on the right side of. In my opinion, the precondition of structurally elevated inflation, historically elevated income and wealth inequality is a very unstable system. These are the kinds of preconditions you see before global war, right? And so ultimately, President Trump recognizing this, having been coached by Steve Bannon via the fourth turning back in 2015 to run for president. This man is a fourth turning president. He understands that now is the time to make big, bold changes to the system. And what I believe, if he's egalitarian, he's probably trying to prevent total war, or at the bare minimum, make the U.S. a little bit more resilient in case that's where we're headed with a country like China or with a country like Russia or with a country like Iran, right? So you need to understand that, this is going to be a long sequence of events in terms of, facilitating the transition for the median income person. I think you have to go down. I think the Trump administration is honest. They've been very honest. Wall Street hasn't been incentivized to pay attention, but obviously now they're incentivized to pay attention. But they've been very honest about the process that's going to take. You got to go down to go up. You got to go back to go forward. This is a detox period, it's economic restructuring. And so ultimately, how this process is likely to play out, you slap the tariff walls up. They initially going to cause chaos and carnage in the economy, right? We know that that's what the markets were signaling. But ultimately, as time progresses, and most importantly, the people who have benefited from this top part of the K recognize that it's them that has to lose the game in order to facilitate this transition. Then ultimately, they start to build factories in America. They start to retransition supply chains. They start to do all the things that the Trump administration wants them to do from an incentive standpoint. That's what the tariffs are, by the way. They're an incentive to build, to reshore domestic manufacturing capacity. And they're not all going to trip over themselves to do that until they recognize the persistency of these tariff rates of this regime. This regime isn't going anywhere. This President Trump is very serious about narrowing this red and blue line here in this chart. And so ultimately, that's that sort of step two is, okay, we've been in this regime for a while. It isn't going anywhere, or else the countries around the world aren't, changing their tariff and non-tariff, lowering their tariff and non-tariff barriers fast enough. So ultimately, we got to start making headway on this. And making headway on this means our profit margins have to go down. It is way more expensive to produce things in America than it is to produce things in China or Vietnam or any of these other places that have benefited from globalization. Their labor forces have benefited at the expense of our labor force here. And I'm not making a political statement of whether or not this is a smart strategy. I'm just making the obvious investor statement that if this is where we're headed, here's how you need to think about the bouncing ball as an investor. That's what my job is as a macro risk manager. I'm not here to opine if this is going to be successful or not. That doesn't matter. I'll tell you if it's going to be successful when we get close enough or further along in the process. But for now, I need investors to be aware that this is a massive, massive economic fork turning style transition. And one of the things that can make that, there's a few things that are going to make this transition a little bit more smooth that I think are very much a part of the President Trump's intentions. One, there's forcing the Fed to lower interest rates and do QE. That'll make this process a little bit more smooth and for asset markets and the people in the top part of the K that are going to have to give it up in profit margin terms, that they'll eventually gain it back in asset price terms. Eventually, again, certainly don't run away and do that. Not from this starting point. Please be aware of that. Number two, there's the tax cut program, extending and expanding, hopefully, for President Trump's all caps tweet yesterday, significantly expanding the Trump tax cuts. And then finally, there's deregulation, right? A significant push forward in terms of deregulating the energy sector, the housing sector, the financial sector, these big key areas of the economy. If they believe if they could do that, plus the tax cuts, extending and expanding tax cuts, plus forcing the Fed to implement, supremely dovish monetary policy, we can find an economic bottom for this sort of to facilitate this transition of reshoring production back to America. So this is a multi-year process. This is not a 2-week process like Wall Street wants you to believe it in. This is not a negotiating tactic, Wall Street. Stop causing your clients to lose money with nonsense. This is a fourth turning multi-year transition that President Trump, who believes he was spared from the assassin's bullet to usher in a golden age, not for the people at the top part of the game that won the game in paradigm A, but for the people on the bottom part of the E that are likely to start to win again in paradigm B.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. I appreciate you really hammering this home because there's still so much denial in markets, especially from the financial sector. So I really appreciate that. So
Can I tell you why?
Yeah, go ahead.
One, I'm very well versed in the fourth turning. Neil Howe's a mentor of mine. I worked with Neil for many years and obviously a friend and a mentor. But secondarily, I grew up down here. This is me. This is I grew up homeless in homeless shelters, sleeping in vans. I understand the plight of the people whose hands he's been shaking for the past decade. I understand how much they've been left behind. And if you go to these towns and shake their hands and leave the hallowed halls of places like where I went to school, Yale and Harvard, or if you leave the coast, us coastal elites, we have no idea the how hard it has been for the people on the bottom part of the K. And so, of course, if you're a Wall Street person or a corporate executive, you just, earmuffs, everything's fine, everything's great. Stock market goes up 20% a year. That's not America. What is America is this right here, this egregiously toxic imbalance that needs to be corrected. And I'm not saying it's going to get corrected or this is the appropriate policy prescription. What I'm trying to say is there's finally a guy with enough gumption and internal fortitude to suffer the consequences of being very unpopular in order to facilitate the transition. And so investors in Wall Street and in corporate America need to buckle up.
100%. Um, okay, so you mentioned earlier about how it feels like a global recession is inevitable for this process to occur, and is that just help me characterize that? Is that because of the sequence of events where, okay, we have the tariffs in now, they're very large, but it's going to take time for the manufacturing base to come back to the U.S. to provide these jobs for these median income earners to actually enjoy and build up the robustness of the broad economy, not just the upwards portion of the K shape. And then furthermore, there's the other more positive, deregulation, tax cuts, et cetera, policies. Those take longer to occur. So it's the air pocket in between those sequences. Is that what creates this tail risk for global recession?
Yeah, I think so. And don't forget, the rest of the world is much more exposed to trade in terms of their share of GDP and share of employment than we are. And so I think if the U.S. could have it, I think our base case scenario right now, based on everything we know today, is that the U.S. has a technical recession. I think it might be a little bit early to call for an actual recession in the U.S. economy, and there's a few reasons why. I'll start by saying we just don't have the kind of private sector balance sheet dynamics in this business cycle that would suggest that a negative shock to growth, however transitory or not transitory it might be, would cascade upon itself and feed upon itself. And so I'll come back to this chart. But number two would be the Fed has not really gotten policy restrictive, and they're actually good. They've already eased, so there's a tail to the easing that we saw in the second half of last year. They're going to ease more, so it's going to make this process a little bit more smooth than most investors realize. And then lastly, we have this labor hoarding phenomenon that is borne out by reduction in immigration, the aging of the U.S. workforce, and ultimately corporate profits that have yet to, go into recession. Now, they're probably going to, and so labor hoarding is not going to persist for a very long time. But until we start to see a breakdown in corporate profit growth, from these currently above trend type levels and above trend type margins, you're not going to see labor hoarding really unwind in a way. So if you're going to make the recession call, the actual recession call, the MBER style recession, which is a broad-based decline in consumption, production, income, and investment, that, in my opinion, is probably a second half story based on the evolution of what we see between now and then. But between getting back to this chart here, I think this is a very important chart to help investors be aware of. So the blue,
Because when you say technical recession, you just mean 2 quarters of negative real GDP growth, but not the broad-based NBER dynamic.
yeah, minimum 2 quarters, yeah, minimum
Right.
two
Okay.
quarters. And NBR is, this is going to snowball and get much worse. It's going to be NBR is one of these red bars. 2022 was a technical recession. We had 2 quarters of negative growth, very significant slowdown in the economy. Obviously, it crashed asset markets. Bitcoin was down about 75%. Stocks were down about 25%. You can have significant bad consequences in the economy from a NBR, from a technical recession. So I want investors to be aware that it's not like I'm bullish because of that. It's just you need to be aware that if you're talking down a technical recession, I think you can think about maybe down 20 or down 30 is the low for the S&P 100. This snowballs into an actual recession based on the precondition, which we'll talk about shortly with respect to our positioning, what our positioning model was signaling at the all-time high. We're talking down 40, down 50. Again, I'm pausing for dramatic effect on that. Like I'm very serious. If we have an actual recession from the starting point of where markets were in late February, you're talking down 40, down 50 in S&P terms. So let me explain this chart before I go unpack that previous comment. So again, as I mentioned, I think it's too early to ascertain whether or not we're going to have an actual recession, an NBER style recession. I think it's a slam dunk that we're going to have a technical recession, but an actual recession requires, much more unwind in the credit cycle. And I just don't see we don't see the kind of capital misallocation, which is creditors lending to sectors of the economy that they shouldn't be lending to because there's a dearth of returns or an excess of supply of capital, or adverse selection, which is creditors lending to consumers and businesses they have no business lending to because they're reaching for yield. Those two dynamics have not. We just don't see those dynamics in this economy. So the blue line here shows the private non-financial sector debt to GDP ratio at 145%. It's been declining this entire business cycle, which ultimately means that nominal GDP growth has outpaced the growth of credit. So it's highly unlikely that we have capital misallocation and adverse selection with that precondition. Right now, if you look at our credit gap, which is the 5-year Z-score of the private non-financial sector debt to GDP ratio at minus 1.6, we are at levels that are like post-recession in terms of credit gap, right? Like typically you're heading into recession, you have a credit gap that's somewhere close to 2 or on its way to 2, right? And so that's my point is that it's very unlikely we have capital misallocation, adverse selection. If anything, the credit cycle's been way too tight. Everybody at the bottom part of the K has been left out of the entire credit cycle, and as a function, left out of the real economy for the past, post-COVID business cycle. The second plot in this chart is the red line here, which is the private non-financial sector debt service ratio. At only 15%, we're rising, but we're still at structurally depressed levels. You go back, we only have data going back to, I want to say 1999, but the last 2 times we went into recession, the private non-financial sector debt service ratio was in the kind of 18 and 19% respectively. We got a long way to go to get the debt service ratio up to a level that, in our opinion, would be consistent with recession. And then finally, if you look at banks' share of credit in terms of what the credit on the economy, even if you were concerned about the elevated level of the policy rate, which I would argue shouldn't be concerned anymore. We know that we're going to get rate cuts this year. Even if you are saying, hey, the policy rate's still too tight, then that's not really the issue from the perspective of the real economy. The real economy, most of the credit comes from the capital markets, about 70% of all credit in the U.S. economy. So, this is a very healthy credit cycle. It's a credit cycle that's much more resilient to shocks than previous credit cycles. Previous credit cycles are basically this sort of Minsky type, reflexively positive dynamic where if anything happens, we're going to go into recession. Very much the opposite of that this time. And so I want investors to be aware that it may be too early to forecast an actual recession, but just because a technical recession is the most likely scenario from this starting point does not necessarily mean we can't go lower in risk asset price terms over the medium term. And then finally, one thing I want to say before we pivot, we talked about the precondition into heading into this transition. I can't stress this enough. Like we were in late February, we were basically at levels across a variety of indicators that signaled high risk of a crash, right? Like rarely do positioning cycle type metrics, whether you look at AI bulls bear spread or the National Association of Active Investment Manager survey or the valuation of the market, credit spreads, AI stock, all these different metrics, especially when you look at the ones that are more stable and tend to correspond to the medium to long-term outlook for asset markets, the ones over here that tend to be a little bit more volatile and tend to have a lot more signal over short-term time horizons. The ones that have signal over medium to long-term time horizons, they were essentially all signaling, hey, they're all consistent with levels that we've observed at major bull market peaks. August 87, July 1990, July 1998, March 2000, October 07, April 2011, September 18, February 20th, and January of 2022. We were breaching the median and or 75th percentile values that we observed in those indicators at the major bull market peak. So what that told me was a couple things. One, investors as recently as less than 2 months ago, not even 2 months ago, were very much positioned for the quote unquote animal spirits trade that, the Trump trade kicked off last fall. And number two, it's very unlikely that Wall Street has done enough research to get to where we are in terms of understanding this fourth turning style transition from paradigm A to paradigm B. This is not the kind of stuff you realize in like 6 weeks. We've been working on this research going since we started talking about the fourth turning in our official research back in the summer of 2023 when we first introduced our investing during a fourth turning regime presentation, which we update for our clients at the end of every one of these macro scouting report presentations. We've been preparing our clients for this kind of major sea change of transition for years now. And so in my opinion, I don't think Wall Street, which was fully positioned across a variety of structural indicators at the all-time high in the SPY on February 19th, has gotten around to acknowledging where we're headed from a paradigm shift perspective. And more importantly, I don't even think they're incentivized to. I think they're incentivized to keep tweeting about negotiating tactics and things of that nature.
Darius, I do want to give you props that I know for a fact that February 19th or whatever, when we were at all time highs, you were using the C word. You were cautioning about a crash, and very well done there. And so, yeah, no, props for that for sure. And so, I want to take that characterization that you just mentioned in terms of comparing a technical recession to this full-on recession that you just mentioned, and compare that with what the market is pricing at this juncture. So we have equities down, let's say 20%. Obviously, it bounced today, but call it 20. We've been down 20. Is that enough to price in a technical recession down 20, or do you see further deterioration? And how much obviously markets are forward looking. So how much at this juncture do we need to start thinking about pricing in the 40 to 50 type percent drawdown scenario that is contrasted with this all out recession that you mentioned?
That's a phenomenal question. I'm going to answer your question, then I'm going to answer the question that I think is more appropriate to answer. So,
Sure.
can you put the chart back on the screen where we show our positioning model. So this is a snapshot of what our positioning model was signaling on February 19th. Essentially, all the indicators, with the exception of the AI bond allocation survey, which was right on the threshold of signaling, they were essentially all signaling, "Hey, we are at sell now. The market's not going to get better than this." These same indicators need to signal buy before you tend to see buy, from these indicators. All the red that you see up here will eventually be green if you're at the lows of a market. And what I'm essentially saying is that we have not had enough pricing in of this transition, right? We've got, the shorter term indicators like AI bulls bear spread, which is only in the ninth percentile. That's a shorter term tactical indicator. That's the kind of indicator that we would signal to our clients who care about the short to medium term time horizon. Hey, AI bulls bear said we got to bounce. This is going to be a tradable low. Trade it. But for most of our clients, we're saying, hey, I don't want you to be trading this. I want you to do exactly what KISS has been telling you to do, which is not participate in the market since the early March, right? That's better because I think trying to trade these tradable bottoms, that's what people get paid millions of dollars on Wall Street to do. If you're a retail investor, you think you're going to do that well, then apply for a buy side portfolio manager job. Don't at least get paid to take on all that additional stress and risk. Don't just be winging around your portfolio with all the money you worked so hard to make over your life. But so that's the key takeaway is that we are not even close to signaling the low from the perspective of these positioning cycle indicators. If you look at the median values that they have historically signaled at major bull market drops, right? You can kind of see this better in a chart. So one of the positioning model indicators is the price to next 12-month earnings per share metric in the S&P 500. Historically, it's breached the 75th percentile value that it's registered at major bull market peaks is somewhere around 24. The median value that it's measured at major bear market troughs, these bear market troughs are December 87, October 1990, October 98, March 2003, March 09, October 2011, December 2018, March 2020, and October 22. The median S&P 500 price to earning next 12-month earnings multiple that we've typically seen there is somewhere kind of just shy of 15. So just shy of 15. So 14.75. Right now we're at 19. If we go down 5 more points, or 4 to 5 more multiple points, I mean, I can't do that math in my head right now while I'm talking, but I'm guessing it's probably worth at least another 10 to 20% down in the S&P terms, right? We lost 4 or 5 multiple points and we were down 20%. So I'm guessing it's pretty similar. So my key takeaway is that this market's not going to bottom until there's a legitimate catalyst for it to bottom. And right now, it's more likely to bottom with the legitimate catalyst and having had the destination priced in. The destination is not priced in. We're probably halfway in terms of pricing in the destination in, but I think you can truncate that whole pricing in process by introducing a legitimate catalyst. And so in my opinion, to answer the question I want to answer now, to me, the legitimate catalyst is one of 3 things. It's, do we see Fed QE? Because, I think you need Fed QE both to give investors confidence to buy the dip, but also make this process of a global debt refinancing in your pocket, more smoothly, which is still a major risk. And I think we're already starting to price it in, right? If you have a negative shock to everyone's growth outlook, then of course, you're not going to run a real corporate credit as smoothly and sailing as you would have otherwise. So I think we're already in the debt refinancing in your pocket. So you're going to need QE to ameliorate that as well. So that's number one. You're going to need the companies themselves to come out and tell you that, hey, what we said about 2025 earnings and maybe even 2026 earnings is just dead wrong. but we're way too early in the process for that. Companies might say the smart CEOs are going to kitchen sink it when they report earnings in the next several weeks. The dumb CEOs are going to say everything's too uncertain. I'm going to pull guidance, right? Then by the way, every CEO is smart. I'm just I'm categorizing them in distributional terms, but my point is that I think we're too early in that process. And then lastly, the one major point of this bottoming process is that we need to see a positive fiscal shock to offset the negative fiscal shock that we're getting from tariffs and Doge. By the way, people forgot about Doge. That's $1 trillion of annualized federal expenditures out of the budget. That's going to hurt too. By the way, when that starts to hit the tape, you need the tax cut relief to come in, and ultimately, if the House Republicans, the deficit hogs in the House, get their way, it's not going to be very stimulative. You're basically just rolling over the Trump tax cuts with $2 trillion of spending cuts. We need the Senate.
It's not net new cuts, right? It's just maintaining the course.
Well, if the senators get their way, then it will be net new cuts. So, so if you look at, so the House plan calls for $3.4 trillion of debt finance tax cuts. It's mostly rolling over the additional the Trump tax cuts. There's a few sweeteners here and there, but by and large, it's mostly that. The Senate plan, which calls for the current policy baseline to be the law. So they have this wonky thing in the Congress where current law suggests that whenever you're talking about rolling over or extending tax cuts, current law says it ends on December 31st. So you're gonna have to pay for everything you extend beyond December 31st. Current policy baseline, which the Congress adopts for spending, they keep spending just in perpetuity. But the current policy baseline, they want to apply to tax cuts as well. If you apply the current policy baseline, it allows them to essentially say, hey, the cost of extending and expanding the Trump tax cuts is essentially zero. So we can, layer on all this additional stuff that President Trump wants as policy priorities, like no tax on tips, no tax on Social Security, no tax on this, no tax on that, no tax on green ties, no tax on brown shirts. You know what I mean? And so my point is that if the Senate gets their way with this debate, you're talking about $7 trillion of tax relief plus additional spending for border and debt. If the House gets its way, it's about $3 trillion of relief. And in my opinion, that $3 trillion from a fiscal impulse perspective is not going to create a positive fiscal impulse. You're basically just rolling over what we have. There's a few things in there that they want that are new. They're going to do the immediate expensing and all that kind of stuff. So that will create a positive shock to 2026 growth and maybe even retroactively applied to 2025 as well to speed up the reshoring process. I expect it to be. But again, these are minor things relative to all the other policy priorities. So I don't know what's going to happen. But I do know that if the Senate gets his way, that's a huge check mark in the right direction in terms of ascertaining whether or not market's at bottom.
Hey, everyone. This episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply. Okay, I want to double click on, you mentioned a couple times now how the Fed needs to do QE to ameliorate the debt refinancing situation. But I also believe you mentioned earlier that you do not believe that the Fed will cut. So I want to understand, how do you square that with what Powell mentioned in Senate testimony a few weeks ago, which is that we don't even thinking about QE until rates are at zero, and then we're still worried about a deflationary shock at that juncture. Is that just, talking out one side of his lip and doing another thing? Or how do you think about all of that? Because when I hear that, I get confused. Are you fading that notion?
Yeah, 100%. It's all good. We're fading the notion because I think we have as good as a roadmap of where we're headed economically in market terms as anybody in the world right now. I don't think there's anybody who's called this with as much surgical precision at every step of the way since last fall. I mean, we started preparing our clients for this transition since last October, with very specific analysis and very specific, checkpoints. And we're hitting a lot of those checkpoints. And so if we continue to hit those checkpoints, The Fed will be forced to do QE. It's not about what they want to do. It's about what they're going to have to do to preserve their mandate, to respond to their mandates. The Fed has three mandates. Fed has a price stability mandate, which we know they are preposterously anchoring on 2% inflation. And I'll come back to that. The Fed has another mandate, which is maximum employment, which obviously, they want to see an unemployment rate that's not triggering the Psalm rule. Otherwise, they're going to be forced to step in and do something about that. And then there's financial stability concerns, specifically, stable and low long-term interest rates. And stable low long-term interest rates, in my opinion, I think if they think that there's an issue with the banking system, that in terms of its ability to capitalize the treasury market, then they will step in and do QE. That's exactly what we saw in the spring of 2023 with the regional banking crisis, right?
So when you say QE, you also mean like term loan programs such as BTFP. It's not necessarily large scale asset programs. It could also be dynamic, such as a BTFP.
Yeah, of course.
Okay.
They're all quantitative easing. They all fall in the bucket of expanding the balance sheet to purchase assets from the market, whether they're lending, whether it's lending or outright purchases. To me, I think that's irrelevant and will be moved to the market. I mean, we saw going back to the COVID in 2020. They had a bunch of lending programs as well, but it marked a bottom in the market as well. So don't fight that as an investor. When the Federal Reserve firefighters get in that fire truck and they go to the burning house, which is the financial markets, and they take that fire hose off the fire truck and start spraying water. Don't stand there shorting stocks. Don't stand there selling stocks. Buy stocks. Buy Bitcoin. Buy crypto. Buy gold. Buy the assets, because they're telling you that they will turn the water hose on higher if you don't buy them. Right? That's the key takeaway there.
And you think cutting Fed funds would be ineffective to solve those issues? It needs to be QE to get the financial stability aspect.
I'm a fan of Michael Howell's work. I generally think he does a good work. Some of his work I can't square the circle on in terms of finding data sets and stuff. Maybe he's he knows people that I don't. But generally speaking, I do agree with one of his key assertions is the interest rate doesn't matter. It's largely doesn't matter. Most of the credit comes from the capital markets, especially in the U.S. economy, 70%. So why would the interest rate matter? The interest rate, it's about the availability and supply and demand of capital, right? The Fed needs to be inserted into this mix to plug the supply of capital hole that is being created by uncertainty, by slowdown in growth, by just a general reduction of investor risk appetite. Don't forget, going back to the debt refinancing problem that we have here. This has been the number one risk for 2025, and I think it's already activated. Right, we're already here in the chart. Right, we're going here over the course of the next 2 quarters. Right, and so what this chart shows, the blue line in the chart is our global liquidity proxy. That's the aggregated sum of the major central bank balance sheets in the world, their broad money supply, and their fiat FX reserves. So the 10 largest economies in the world. The red line shows the total non-financial sector debt on a year-over-year rate of change basis. That is lagged by 4.5 years to simulate the earliest wave of the global debt refinancing cycle. Typically, you're talking about on average, you have a bond that matures in 5 years. Corporates, particularly in corporates, they generally want to get out ahead of that. They don't want that debt to hit their current, their income statement essentially. So they tend to start refinancing 6, 9, 12 months early. So we're early in this sort of refinancing pocket. And right now, you're essentially having global capital allocators, not just domestic, but global capital allocators taking their ball and going home and saying, I don't know if I want to capitalize assets right now. If anything, I want to sell them because I was levered long them on February 19th when Darius' position model said that. And so you have this, kind of, I wouldn't say decline in liquidity, but it's certainly we're growing at a very tepid pace. And we're growing at a very tepid pace that will not keep up with this sharp acceleration in the large growth rate of total non-financial sector debt. And the reason this is important is because every time we have what we call a debt refinancing air pocket, means total non-financial sector debt globally declines, bad stuff happens. This is when crashes happen in risk assets and the global dollar scarcity. So this chart we show, the shaded area curve is the total non-financial sector debt. The blue line is our global liquidity proxy, and the red line is S&P 500. And what you see is the black dotted lines correspond to the deep corrections and/or crashes in the S&P 500 that we've had since the start of the global financial crisis. You got obviously the GFC, summer 2010, summer 11, 15 and 16, Q4 18, COVID, 2022, and then ultimately the summer of 2023. In each of those, with the exception of COVID, you've had a drawdown in total non-financial sector debt, a drawdown in global liquidity, or both. And so that's a pretty consistent feature of these major, declines in asset markets over the past, kind of 15 plus years since the GFC. And so the reality is if the Fed doesn't do QE, we are going to have a significant drawdown in total non-financial sector debt globally. And we may even have a significant drawdown in global liquidity as well. Because again, don't forget, the Fed and central banks aren't the only people who create liquidity. We get great liquidity when the households generate household savings, and corporates generate corporate profits. That money winds up in capitalizing asset markets. And so if we have a significant sharp deceleration in growth and or a global recession, you're going to have a decline in private sector generated liquidity. And so you need entities like the Fed and the PBOC to come in and step on the gas. But the problem is they're so myopically concerned about this ridiculous 2% inflation target. I think the last time you and I was on the program, you and I talked about this.
We did, yeah.
Our second, and let me summarize this really quickly for folks. Our second inflation model, which we've been publishing to our clients every month since January of 2022, has consistently said that the equilibrium core PC inflation rate in the U.S. economy is right around high twos, low threes. And so what does that mean? It means the horizontal line in this chart, or the horizontal line in the stylized diagram, is somewhere, the mean of that is somewhere around high twos, low threes. We don't, it can be much more specific than that. It's currently signaling somewhere between 2.9 and 3%. That means that in order to create sustained 2% inflation, the Fed has to maintain a sustained restrictive monetary policy. And in my opinion, this is the policy mistake they're already making right now here in 2025, is that they want 2% inflation in an economy that naturally is going to have 3% inflation. That is a problem. That is a structural problem for investors until the Fed acknowledges that the economy, this is a 3% inflation economy, not a 2% inflation economy. And how do we determine that? What this model does is it interpolates the normalized change in these key indicators, which we found from our research and other academic literature to be correlated or co-integrated with the underlying trend in core PC inflation. And so, for example, deglobalization is adding a modest amount of inflationary pressure. Demographics is adding a modest amount of disinflationary pressure. Fiscal policy is adding a modest amount of inflationary pressure. Housing supply, the lack thereof, is adding a meaningful amount of inflationary pressure. Productivity is adding a modest amount of disinflationary pressure. The proliferation of technology like AI, all this stuff is adding a material amount of disinflationary pressure. Wages, the trend in wage growth is adding a meaningful amount of inflationary pressure. And then what we call our West Village Montauk effect, which is the amount of cash on household sector balance sheets that could be spent into the real economy at any given time, that's adding a ridiculous amount of inflationary pressure. There's almost $10 trillion of cash when you include checking deposits and money market fund exposure on the household sector balance sheet. Do you know what that number was prior to COVID? 3.5.
No, damn. Wow.
$7 more trillion of money floating around. And guess what? You know why the electoral college map was all red? Because the money only went to the rich people. That's it. All the money is trapped on balance sheets of people like around talking about charts and investing in crypto and stocks. It didn't go to anybody in Ohio or Michigan or Wisconsin or Nevada or any one of these states that have been completely left behind by the globalization and the financialization of the economy, which takes me back to my original point. The only way for this process to conclude is twofold. One, President Trump hits the emergency brake and says, no, wait, let's go back to Paradigm A, which seems like a very unlikely event in the context of somebody who survived an assassination attempt. Or number two, the people who won the game in Paradigm A acknowledge that they need to lose the game in order to facilitate the transition. And the only way that they're going to do that is more pain. And ultimately that more pain will cause the Fed to temporarily, at least, disregard its 2% inflation target and start to supply the market with the liquidity we think we're highly expecting them to supply. But again, that could be months away just based on the most recent commentary from Jay Powell.
Okay, so for our last part of our conversation here, I want to take that nugget of secularly higher inflation above target and bring that into how to think about portfolio construction. So correct me if I'm wrong, but you've created a rule where there's no more fixed income in your long-term portfolio construction process. So yeah, walk me through with that as context. How do you think about portfolio construction in such a huge regime shift?
Felix, thank you for allowing me to land the plane on this, because one thing I'll say for investors, it's super important. I think this is the most important thing I say in every single podcast. I spend most of the time outside of our paywall talking about things like growth, inflation, liquidity, monetary policy, fiscal policy, because that's what makes for good TV. But what makes for good investments are institutionalized risk management frameworks that help you time markets appropriately. I can know everything there is to the world about global liquidity, about monetary policy, fiscal policy, tariff policy, all this other stuff. But if you don't have systems that allow you to time that knowledge and actually make money when they're in bull markets and or minimize downside capture in bear markets, then it's useless knowledge. It's useless knowledge. And so I want to make sure as we enter this kind of final part of the conversation that what we do for our clients at 42 Macro is take all the useless knowledge that's floating around in my head and everybody else's head and actually turns it into actionable, specific investment advice for the general investor. And this is our KISS portfolio construction process. It is a 3 ETF solution that allows investors to take advantage of the secular bull markets in stocks, gold, and Bitcoin, while also risk managing the downside when we go into these cyclical bear markets. And that's exactly what we've done for our clients. Again, this is the second bear market we've helped our clients, get to safety ahead of since, December of 2021, heading into 2022. It's 2 bear markets in 3 years, right? So what we've been arguing for years is that, when you're in a fork turning, our empirical analysis shows that you have faster appreciation in risk assets, but you also have deeper drawdowns in risk assets, and the frequency of those dynamics speeds up. And so you actually do need sophisticated risk management systems to navigate it forth turning appropriately. You don't have to navigate it appropriately, but if you want to have more money at the end of the process than less money, specifically a lot more money, then you should navigate it appropriately and partner with people who can help you do that. So let me briefly go over where we are today and how we get to those allocations, because that'll help explain how the system actually works. And to your point, we pivoted this system out of bonds completely going back to last October with the expectation that bonds are highly mispriced as an asset class in the context of what's likely to occur as we move forward in time in forward turning terms. What's probably going to happen at some point between now and 2030 is the US has a Liz Truss moment in the treasury market. There is a egregious, and we can talk about this the next time I'm on the program, there is an egregious supply-demand imbalance in the treasury market that's brewing. And if the Senate gets its way with the current policy debate and we emerge from a global cyclical downturn, the world's going to wake up to a world where the US is playing a lot less nicely in the sandbox from a globalization perspective. They're playing a lot less nicely in the sandbox from a geopolitical perspective. And oh, by the way, we need their money to capitalize the treasury market. And those 3 things are very incongruent with the Congress that has debt kind of just growing in, as far as the eye can see in terms of their unwillingness to offer real solutions to that problem. But again, I don't think that's a problem that we need to worry about today. Right now, bonds have been rallying because we're heading into a cyclical downturn. But to me, that's a temporary phenomenon in the context of a longer secular term bear market in bonds.
They're good to trade, but not to hold at this point.
Exactly. Thank you. So, so this is our KISS process. This is where we are today. We've been largely positioned like this for a while now. So we're at 67.5% cash. We're at 0% of our maximum exposure of 60% in equities. We sold our equities to 0%, I want to say on March 5th, and have been 0% since then. So we missed the vast majority of the downturn. We're at 100% of our maximum exposure of 30% in gold. We bought gold last week. We were at 15% in gold since, I want to say January, but we bought the additional 15% in gold last week. And then Bitcoin, we're at 25% of our maximum exposure of 10%, so 2.5% there. And so how do we get to those allocations? This is a completely systematic system. The system does not factor in anything I say about the future with respect to growth, inflation policy, liquidity, tariffs, et cetera. All the system does is respond to is our market regime nowcasting process, which tells the system what regime we're in, because that'll determine the target allocations. Where we're in a risk-on regime, the target allocations for the equity and crypto exposures are maxed out at 60% and 10% respectively. We're in a risk-off allocation. The target allocations for the equity and crypto exposures are cut in half to 30% and 5% respectively. So that's step 1 of the process. Step 2 of the process is the bottom-up risk management overlay. So the volatility adjustment momentum signal for each of these assets, SPLG for stocks, GLDM for gold, and BTC for Bitcoin, that will determine the dynamic position sizing component. So it'll either be 100% of the target allocation. It'll be if the asset is bullish, it'll be 50% of the target allocation if the asset is neutral, and it'll be 0% of the target allocation if the asset is bearish. And so right now, in terms of getting to this 0% allocation of stocks right now, we're at 0% of the target allocation of 30% because stocks are bearish and we're in a risk-off regime. Gold, we're at 100% of the target allocation of 30. The target allocation for gold is maxed out at 30. It can perform well in any regime. And then for the sector Bitcoin, the exposure is half of the target allocation of 5%. And so those systems are systematic. They're institutional grade risk management overlays that infuse volatility targeting and dynamic position sizing into the system. And the reason we have so much confidence in the system, 1, is because the system works. It's very effective. dramatically outperformed 60/40. And if you wanted to compare it to a, kind of naked long portfolio of stocks, gold, and Bitcoin without those overlays, without the dynamic position sizing and the volatility targeting that makes KISS what it is, you would get the same return. You would have an upside capture ratio of 104% relative to naked long stocks, gold, Bitcoin, 60/30, 10 stocks, gold, Bitcoin, but you'd be cutting off half of the downside with the downside capture ratio of only 49%. So this is why people in institutional finance get paid. They get paid to help clients participate in bull markets, but also chop off the left tail. And so that's
That
exactly
part is so important because again, for the retailer base, like the risk adjusted return is what matters. Is that just by being able to cut off that 49%, I'm sure, yeah, you have your Sharpe ratios here. It's just incredible.
Oh, thank you. I appreciate you saying that, man. No, look, this is I cut my teeth on Wall Street, and eventually I just got tired of making rich people richer. That's the ethos of our firm. Jackie Robinson's quote really changed my life back in, I want to say, in 2020, when I started kicking the tires on leaving and starting a. In fact, I was going to start a hedge fund that essentially allowed regular people to invest in a hedge fund, but turns out the SEC is not a big fan of that. So we wound up starting a research business instead, to give clients access to institutional grade systems. I don't think I'm doing anything particularly novel. There's risk management is not a novel concept. If you go to places like Citadel, Millennium, or Point 72, et cetera, what we're doing is just allowing retail investors to finally participate in what those guys have figured out years ago. And so I'm really proud of what we're doing for our clients. As you guys can see, I'm sure my Twitter is incredibly annoying. It's like a thousand tweets.
Though.
Yeah, no, look, it's 1,000 tweets of people saying, thank you. You saved my family's, retirement future. I'm in retirement. You basically allowed me to continue living a comfortable lifestyle. Those are the kinds of people that we set out to help when we started 42 Macro. And don't forget, we advise on $25+ trillion of client assets. So obviously we got a lot of the big boys paying for our research as well. And we're very happy and grateful that they're supporting our business as well. But, the reason Darius Dale gets out of bed is to help people that grew up like Darius Dale retire on time and comfortably. So I'm really grateful for this opportunity to present KISS to your audience. And hopefully, folks, if they're finding that winging it, trying to piece the puzzle together in their brain and react to that in their portfolio with the asset allocation, portfolio construction changes, if they're finding that their results they aren't achieving the desired results, then just give KISS a try. I highly recommend it. It'll be improved.
I think to that point, though, it's, sometimes I get some comments to myself where they're like, Felix, how do you navigate trading when you just listen to so many different opinions on your podcast and you interview different people? And it's like, well, that's not how I trade. That's just, it's intellectually fascinating for me. It's my passion. It provides some new ideas to bring into a framework, but, I'm not just interviewing somebody one day and they're bullish. So I'm like, oh crap, I'm going to go buy. And then, oh, this guy's bearish, I'm going to go short. That's not how it works. So I appreciate how clear you are about that aspect.
No, I'm so glad you said that, man, because I always thought that too. It's like put yourself in the position of a retail investor, right? Like they're watching all kinds of, they're constantly, I mean, everyone who's investing is probably passionate about investing. I can't think of a more like intellectually stimulating activity and then trying to predict the future and profit from that. Like it's fun. It's very, very fun. I love what I do. And I'm pretty sure most people who invest love what they do. But boy, it's got to be very hard as a retail investor. Like, again, you have thousands of sources. And it's not like you can have your favorite two sources be like one's a bull, one's a bear. How do you deal with that? And so to me, I find that investing systematically it takes the hard part of investing away from me, right? If I'm right on all these fundamental predictions, then the KISS allocations are just going to do what they're supposed to do along the way. But the reason I love investing systematically is because if I'm wrong on my fundamental predictions, the systematic signals will make my portfolio better faster, right? It takes investors, and this is another institutional knowledge dart that I'm dropping here. You pivot slower. In fact, can I put this chart on the screen? It's one of my favorite slides ever. I finally figured out how to explain what we do relative to what everyone else's does. When you invest solely on the basis of fundamental predictions, you literally have to wind up in a traffic jam to figure out that something is wrong, right? Like you literally, or crash your car, it's like MapQuest. It takes you longer to say, oh my God, that was wrong. Now I have to pivot. When you invest on the basis of systematic signals, and I surmise that our signals are really, really effective. They're absolutely, they've helped our clients manage to stay on the right side of market risk since we started the firm 4 years ago. That's a pretty long period of time. But even if you don't agree that our systems are good, just systematic signals in and of themselves allow you to truncate the amount of time that it takes to go from, error in my portfolio to correcting the error in my portfolio. And so that's one of the things that I really want investors to take away. One of the most important things I think in this, highly stressful, critical market juncture is to think about investing differently. Don't just be focused on when do I buy the dip, when buy, when Lambo, when this, when that. I think as many of these as we're going to go through in the next, 5, 10 years, at some point we have to just change the way retail investors start approaching markets. Folks need to just grow up and accept the fact that this is a lot harder than win buy, win Lambo, and they need to start incorporating better signals and better process into their investment process if they don't want to wind up, in the poorhouse somewhere down the shore.
Amazing. Darius Dale, 42 Macro. What a great conversation. Thank you again. Where can folks go if they want to see all this research? How do they learn more?
Well, I appreciate you, Felix, man. Thanks again for everything you guys do for global investors, too. You bring together a lot of thought leadership, very institutional, great thought leadership, by the way. Somebody tweeted, I tweeted at CNBC and Bloomberg. I was like, hey, like, I don't think anybody in the world has called this with more surgical precision than we have for the past 6 months, by the way. You guys are all waking up to it in the last 2 weeks. It'd be nice if you guys can invite me on the show so I can help more people. Not a single one of them replied to me. Of course they didn't. I don't think they're incentivized to have people like me talk to their audience, because people like me bypasses Wall Street. I'm allowing I'm allowing people to bypass Wall Street, the people who want you to pay them to manage their money, or the people who want you to pay tens of hundreds of thousands of dollars a year for their research. No, I'm allowing you to bypass all that as a retail investor. So that's probably why they're ignoring me, but that's neither here nor there. Come check us out at 42macro.com. I'm on Twitter at Darius Dale 42. Appreciate everyone who decides to follow us, participate in us, and check us out, man. It's a real blessing to be here.
Amazing. All right. Thanks again. Appreciate it.
Appreciate you, Felix. Thanks again.